Perhaps the best way to analyze your company's financial position is to do a ratio analysis. That's because you'll have very specific questions about a certain aspect of your company, and a ratio exists, there's a ratio for that, that will allow you to get information that you need about how well you're performing in that certain aspect. So, what is our ability to pay the current liabilities that we have? What's our ability to sell merchandise inventory and collect on the receivables from those sales in a timely manner? What is our ability to finance and pay off our long-term debt? How profitable are we? And how do we look in terms of our stock as an investment for potential investors? All of these have their own separate formulas. And what would you need to figure this out? Well, really, you just need a comparative balance sheet and a comparative income statement. Yes, there's other information you may need. You may need a statement of cash flows in there, or maybe even an equity statement for other purposes. But the vast majority of ratios, these two documents will give you all the information that you need to figure out something in particular about your company. Let's start with our ability to pay off our current liabilities. We have vendors that we owe accounts payable. We probably have employees that we have to pay. There's going to be some salaries payable. There might even be some short-term interest payable on there. We have all these things that we know we're going to have to pay in the short-term future. How well are we going to be able to do that? Well, we can look at 4 different metrics in this case to figure that out. We have working capital, the cash ratio, the acid test ratio, also called the quick ratio, and the current ratio. Let's go by them one by one. Working capital simply measures the excess amount of current assets you have, the amount of stuff that you expect to convert to cash within the next year, above the current liabilities, the stuff that you're going to have to pay for within the next year. And the formula is simply that. Working capital is current assets minus current liabilities. So we can see right here from the numbers that Smart Touch has had, that we've been using so far in this PowerPoint, that last year their $236,000 of current assets was $110,000 greater than $126,000 of current liabilities. In 2026, this year, we see that we're up to $262,000 of current assets, which is $120,000 greater than our $142,000 of current liabilities. We definitely have the ability, as long as all things go proper and we convert all of those current assets into cash one way or another, we have the ability to pay off all of the debt that we're going to have to pay within the next year, and our margin of safety, if you will, is getting even higher. So our working capital ratio, looking pretty good, especially compared to last year. But that problem with working capital, not that there's a big problem, but one potential problem is you are counting on being able to convert all of those current assets into cash to finance those short-term liabilities that you have. But what if you had to pay something today, or all of it today? All of those current liabilities are becoming due. Well, you might not have time to do that, to convert all of your current assets into cash. So let's drill down a little farther on our liquidity, on our ability to pay off our current liabilities with what we already have in cash or cash equivalents today. And cash equivalents is basically just financial instruments that work like cash. Most banks will have short-term certificates of deposit. That'd be one thing that would count right there. We'll just refer to it like our cash for right now. What percentage of the debts that we have to pay within the next year could we pay off with the cash that we have on hand today? And you take your cash plus cash equivalents and divide it by your current liabilities to figure this out. So in 2025, we had $32,000 of cash against $126,000 of current liabilities. Last year, we had the ability to pay off 25% of those current liabilities with the cash that we had on hand. At this very moment, when we're looking at the end of the year 2026 balance sheet, we have $29,000 in cash versus the $142,000 in current liabilities we owe. $29,000 divided by $142,000 is 20%. So we can only afford to pay off 20% of our current liabilities with the cash that we have on hand today. We went down. We have less liquidity in terms of just our cash than we did last year. How do we compare against the industry, against everybody else that does stuff that Smart Touch Learning does? Well, the industry average is 0.40. So all of this put together tells a manager that we're cash light, it's getting worse, and we're well below what other people operating in our industry typically have in cash reserves at any one given time. But it's highly unlikely that all of your current liabilities are going to be due today. Like some things are going to be due a little bit down the road. Vendors give you a certain amount of days to pay. You don't have to pay your employees until the next payday, etc. So what would happen in this case if we had the ability to convert some of our assets that are incredibly easy to convert into cash before we had to pay those current liabilities? So we already talked about cash and cash equivalents. Well, other things could get converted to cash real fast. Short-term investments. We can just go on to whatever brokerage website we use and sell our stock and get cash for it. And we also have our receivables. There are businesses that exist, they're called factors, that will buy receivables off of your company for pennies on the dollar. So if you needed to in the immediate short-term future, you could convert all your receivables into cash. So now we're going to look at this situation. What if we had to pay off our current liabilities given enough time that we convert short-term investments and our receivables into actual cash? Well, this year we have $29,000 of cash. We don't have any short-term investments, and we have $114,000 in receivables against our $142,000 worth of current liabilities. Add up all the stuff in the numerator, divide by that $142,000, and you come up with 1.01, which means if we have the ability, since we don't have any short-term investments, if we have the ability to convert our receivables into cash before we have to pay our liabilities, we could pay those current liabilities 1.01 times. That is better than we were last year. We were only at 0.93 for our quick ratio, or acid test ratio. And both of those figures are above the industry average. So we were like double the industry average last year, and we're getting even better. Which means, while the previous slide makes it look like we're going to be insolvent, like we're not going to be able to pay our debt with cash that we have, we see right here that we do have enough highly liquid assets that we can convert to cash quickly to finance our current liabilities. And then let's take that time scale and make it a little longer. Now we can convert all of our current assets into cash. Like, what current assets weren't listed on the top back here? Inventory. You can't force somebody to buy inventory. It might take you time to convert that inventory into cash. And prepaid expenses. You prepaid for your rent or your insurance or whatever. It's not like you can go to your landlord or your insurance provider and get a refund on that. Those expenses that you prepaid for are going to help you conduct operations and be profitable, and will eventually turn into extra cash for you. So what happens if all of that happens? We are able to convert all of our current assets into cash to pay our current liabilities. Well, right here, according to our balance sheet in 2026, we had $262,000 of current assets against our $142,000 in current liabilities. That's 1.85 times. If we had the ability to convert all of our current assets into cash, we can pay off all of our current liabilities almost twice. While that is down slightly from the 1.87 we had last year, we're still like 3 times the industry average right here. So this is further reinforcement that while we might be cash light at this very moment right now, we definitely do have the ability in the short term to obtain enough cash to pay off all of those current liabilities. Another very useful thing to do with ratio analysis is look at the speed of your operations. How long is it taking you to sell inventory once you have it in a state ready to be sold? Once you sell it, you're usually going to do it on an account. How long is it taking you to collect on those receivables from the sales that you had? And all in all, that inventory that you're selling on account, how does the markup, the gross profit that you're making off the sale of any one unit, look compared to what you want it to look like? Well, let's break down these formulas individually. The first thing we have is our number of inventory turns, or our inventory turnover, which is kind of a weird concept to think about. It is a measure of how many times your company will sell its average level of inventory during a year. What is an average level of inventory? For me, the easiest way to conceptualize it is to think about a big retailer like Walmart. They have to stock their shelves. How much inventory does it take to stock their shelves? Because they keep their shelves fully stocked at almost all times. Well, that would be the average amount of inventory that they had on hand. So every time they clear out their shelves entirely, I know they don't do that, but hypothetically, if they did, they cleared out their shelves in its entirety over, it'd be 1 turn. So we can calculate out the number of turns we had, the number of times we flip the average level of inventory we have on hand at any one given time during a year. So for Smart Touch, our cost of goods sold in 2026 was 513,000. We're going to divide that by our average level of inventory during the year. And how you find that, the best way to approximate that, is to go to your comparative balance sheet, take your last two reported levels of inventory and find the average of those two. And how you do that is you add them together and you divide by 2. And after we math this all out right here, we see that Smart Touch Learning had 4.58 inventory turns per year. They have a certain amount of inventory on hand that's usual for them, and they flip through that inventory 4.58 times during the year. What about the industry average that we operated? So much higher than us, 27.7 times. And don't overthink it. Imagine you're two different retailers comparing your Walmart versus Target. Similar size, similar store shapes, etc. I bet you if Target is clearing out their shelves 27.7 times per year versus Walmart's 4.58, they're going to be way more profitable in the long run. So the higher your number of turns, the more profit you're more likely making. I'm not the biggest fan of turns. The reason I'm teaching it is because I love this ratio, and you need to know your number of turns to figure it out. This, to me, is much easier to conceptualize. What we're saying right here is this is the number of times we flip our average level of inventory every year. Well, if we take 365 and divide it by our number of inventory turns, that 4.58 we just calculated, we figure out how long it takes us to clear out our shelves, to sell our average level of inventory. And you can even go down further and look at it. This is how long it takes to sell any one piece of inventory after we put it on the shelves. So for us right here, we have 365 days divided by our 4.58 turns. That comes out to 79.7, almost 80 days. If we take this down to the most micro of levels, once we have a product that we are ready to sell, it's taking us about 80 days to sell that product. Everybody else in our industry is selling in about 13 days. So just like before, this is further reinforcement that we have a problem right here. Our inventory is not moving like it should be. We're not, flipping through inventory as fast. People are not buying our goods as quickly as we would like. And it could also be a volume problem. We have too much inventory on hand at any one given time to clear out, as opposed to our competitors, which keep a much smaller amount of inventory, but flip through it constantly. What about the sales of that inventory? Are we making enough profitability off it? Well, you would just take your gross profit and divide it by your sales revenue. So go to your income statement, find these two numbers, 345,000 divided by 858,000, the numbers that we saw in the income statement earlier, comes out to 40.2%. So 40 cents on every sales dollar is ending up as profit. The industry average is 43%. So we're close, but we're still not as good. So not only are we taking longer to sell inventory that we have than our competitors, but when we do sell it, we're not making as much profit off it as our competitors. And then let's move on to the receivables turnover ratio, because at this point we only have sold it. We've not yet converted it into cash. How long is it taking us to actually collect on those sales for our customers to pay us after we sell to them and we bill them? Well, to do this, you take your sales revenue for the period, net credit sales, if you will, which is 85,000. You wouldn't put cash sales in here because they're already converted into cash. Then you divide it by your average AR. And just like we did before with inventory, go to your balance sheet, find your last two reported balances of accounts receivable in this case, and find the average of those two. So add them together, divide by 2, and then when you find that number on the bottom, little mental math right now is telling me that that's 99,500. You would take your sales, divide it by whatever you get on the bottom right here, and it comes out to 8.6, which means we have an average level of receivables on the books. Like, we sell stuff all the time. It's typical for us to have a certain amount of receivables that we're waiting to collect at any one given time. Whatever that average level is, we're only collecting at 8.6 per year. Our competitors in our industry are at 29.1, which means that they collect that average level of receivables they have outstanding at any one given time much faster than we do. And you want to collect receivables as fast as humanly possible, so then the higher your number of AR turns in this case, the better your company is. And just like the inventory turnover ratio, I'm not a fan of the concept of turns, but I need it for something that makes way more sense to me in my head, which is our days, sales, and receivables. If we take our 365 days in our operating year and divide it by that number of AR turns that we had, we can express it in terms of days. So there's 365 days in the year. we did 8.6 turns on our receivables, which comes out to 42.4. 42.4 days is how long it takes us to collect the average amount of receivables we have outstanding in any one given time. Take it down even smaller, you can look at it as that's how long it takes you to collect on a sale that you've made once you've made the sale. So we sell to somebody, we bill them, and it's taking us on average about 42 days to get payment. Well, the industry average is 25, so we're much slower than our competitors. And this process, all three of these ratios together tell the bigger picture. Let's go all the way back here to our days sales and inventory. We are taking like 80 days, we'll round off right here, to sell goods once we have it finished. After we sell it after 80 days, it's taken us another 42-ish days to collect on them. Add those two together, it's 122 days. It's like 4 months. By the time that we have one piece of inventory ready to be sold, it's taken us like 4 months to turn it into cash. And the worst part is we didn't even make as much profit off of that inventory as we could have. And here is the purpose of this ratio analysis. We got proof in numbers right now that we have an issue compared to the industry. Everybody else is doing a much better job of producing inventory at the right volume, selling it to the right customers that will pay you quickly, and maintaining the profit margin off of that sale.